Afternoon, everybody. How are we doing today? How are we doing on this Thursday afternoon here? If I can get a quick audio and video check, let me know that I'm coming through loud and clear, that you can hear me, and that my screen's coming through. All right, thank you, Ed. Hey, Stephen, how you doing? Hey, Sandra and Chuck. All right, everybody, good to see you guys. Hey, Ken, hope everybody's had a good trading week so far here, and looking forward to a good weekend here. We're almost to the end of our trading week here. I'm going to get everything up and going here. Let's get our recording going. All right, hey William, how you doing? All right, well, welcome everybody to the Nadex Application and Strategy webinar series. My name is John Skelton. I'm with apexinvesting.com, and this webinar is brought to you today and hosted by Nadex. And today we're going to talk about the common mistakes that Nadex spread traders make. If you've been with us recently, I believe it was last week, we kind of cycled back through, and we know that we've got a lot of new traders with us and a lot of traders that are brand new to Nadex. So we've kind of gone back and kind of recovered some of the basics, kind of some 101s here. But last week we talked about the basics of spreads. I know some of you are either brand new or have been with Nadex for a little while and been trading Nadex binaries, and you're aware of spreads, but you weren't quite sure what they were and how they worked. So last week we talked about the very basics of spreads. We started kind of from the foundation and started from the ground floor, and I kind of walked you through what is a Nadex spread, how does it work, how are they valued, and we kind of laid the foundation. So today we're going to kind of take that one step forward and talk to you about some of the common mistakes that spread traders make. And we're going to kind of walk through, you know, just like with binaries, you might understand how binaries work technically, but there's a ton of different binary strikes and options to choose from on the Nadex platform. And it's the same with spreads. You'll see a bunch of different expirations. You'll see different floors and ceilings and different spreads, and they're priced differently. And so we have the basics down, but now we want to kind of go into a little bit advanced trading of spreads and help you understand why there's different ones and how different spreads are, you know, how they're priced differently, but also how, you know, how and why they're a little bit different as far as choosing the right one for your strategy and system. And, you know, I've talked to some people that say, hey, I understand spreads, but every time I jump in and trade them, they don't quite work for me. I don't quite, you know, profit from them the way that I thought I would or the way that I think I should. And today's webinar is going to clear most of those issues up and show you exactly what's going on and why you might, you know, have a great strategy or system. You might be calling the direction of the market properly, and you may be making the right decision to trade a spread there, but maybe you're just choosing the wrong one. So that's what we're going to cover today. So let's knock out our disclosure so we can jump right in here. Trading futures, options, or any financial instrument involves risk and may not be suitable for every investor. And any examples used are not a recommendation to buy or sell or solicitation to buy or sell futures, options, bonds, binaries, or Nadex spreads of any kind. So keep in mind, any example of a trade that I show you today or any trades we might enter in on the demo platform here, it's strictly just an example as I'm going through and teaching you these common misconceptions and mistakes. Just an example of entering an order, showing you how to use the Nadex platform and how to use the Nadex tickets. It's in no way a trade recommendation or advice, just simply for informational and educational purposes only. And as always, past performance not indicative of future results. Okay, so for those of you that are brand new, hop on over to nadex.com, and if you don't have one already, I want to encourage you to open a demo account. If you're on the Nadex website and you go right here under trading platforms, you'll see a few different tabs. Obviously, you can go online to the Nadex platform directly. They also have a mobile app that you can use from your smartphone to enter and exit orders, manage trades, and so on. But right here, demo trading platform. This is very powerful. Something that Nadex is just amazing at is giving you a ton of free education, ton of free tools and resources. And one of the very first things you need to take advantage of is Nadex will give you a $25,000 demo account. All right. All you have to do is select a username, fill out some quick information, and hit submit. All right. And in just a few moments, you'll get an email with a temporary password. You can log right into the Nadex demo account. And once you do that, you can go right up here to My Account, and then to Settings, and right here, Password. And you can go in and change that temporary password they give you, and to kind of personalize it and make it your own password, easy to remember. And you'll be able to log right into the demo account. But they'll give you a $25,000 demo account, which is great. It helps you get familiar with who is Nadex, what is Nadex, get familiar with the platform and all the different options that Nadex offers as far as binaries and spreads, the different instruments and expirations, entering and exiting order tickets. Just a great place to get familiar with how to use the platform using demo money as opposed to your live money. But it's also a great place if you're learning, maybe you're a binary trader and you're just now learning spreads, okay? Well, or if you're trying to learn a new strategy or system, master it in your demo account, test it in your demo account till you get a handle on it. Don't use your live money to test something new, okay? And once again, if you're a binary trader, you've never really, done anything with spreads, well, let's say you trade binaries in your live account every day. Well, great, keep doing that, but, test out spreads. When you whatever strategy or system you're using, when you get an entry on binaries and you're taking that in your live account, throw on a spread in your demo account at the same time. Play with them as you get to know them and understand them and master them, and then you can move over to live. So definitely take advantage of that. And yeah, Ken, there's been a few upgrades, a few changes. There's been some additions of a few things, and they've added on some extra pairs here for the 5-minute binaries. So yeah, definitely check it out. So take advantage of that. Also, if you're on the Nadex website, if you've been with us recently and been watching the webinars, but maybe you might have missed a few, another great place right here, the Learning Center. As you see, there's a bunch of different tabs here. You've got webinars, videos, trade examples, handbooks, just a ton of free education here. Right here in the webinars, this will show you the upcoming webinars that are coming up in the future. That way you can see what subjects are going to be covered, get registered for those webinars. Right here you can go to Webinar Archive, okay? And right here, Filter by Presenter. If you click this drop-down box, you'll find us right here, Apex Investing Institute, and you can see recordings of the past webinars we've done. For example, today's webinar is being recorded, and if you want to go back and watch it, this is where it will be posted later on, okay? For example, last week, like I said, we covered the back to the basics with Nadex Spreads. So if you missed that last week and you want to go catch up on that, like I said, we're kind of building on that foundation today. Recently before that, I covered the basics of Nadex Spreads. So again, some of this stuff and even some of today's stuff, if you've been trading for a while with Nadex and been trading spreads for a while, some of what we're covering today might be very basic or elementary for you. Okay, well, we've got a lot of new traders, and we have to remember we were all here once, right? All of us were at some point brand new and just trying to get a handle on, these Nadex products and understand them. So that's what that's what today's webinar is for. Also, it's always a good idea to go back and cover the basics. I talk to spread traders all the time that are like, man, I kind of forgot about some of these things. I knew them, but I forget them day to day in my trading. So it was great to recover some of those basics, especially to recover, some of those basic and common misconceptions and mistakes that traders make with spreads. So once again, my name is John Skelton. I'm with apexinvesting.com. Apex and Nadex, two complete separate companies. Nadex is an exchange. Apex, we're an online education company. We're a group of traders helping traders. We've got over 20,000 members. We've got live trade rooms and indicators and software and systems, but we focus a lot on risk management and probability. That's why we love the capital risk products with Nadex. And we're traders just like you. We do these education webinars for Nadex. And once again, we're here, and Nadex is providing us to be here for you just to give you some free education information of who and what is Nadex, how do the products work, how can I utilize them in my day-to-day trading and incorporating them into my strategies. So I've been with Apex now for about 3 years as head of operations. I've got a background in as a stockbroker and in the banking industry. We're an educator, and once again, just a trader just like you. We trade Nadex spreads and binaries every day. So let's jump in here. Today, we're going to talk about common mistakes that Nadex spread traders make. We're going to talk about some common misconceptions that I've seen quite a bit of, and how those misconceptions can alter your perception and cause you to not choose the right spread, okay, for your strategy. And we're going to talk a little bit about the value of a spread and premium and pricing. Okay, so we're not going to go back through and cover the basics of spreads again today. Like I said, if you missed last week when we walked through those basics, I kind of just showed you there where you could go to watch that video there. But something I always like to say is there are a couple of comparisons I'll make today between binaries and spreads. But the first thing you have to do to really truly understand spreads is to not think like a binary trader. Okay, it's not at expiration, it's not all or nothing based on one tick or 1/10 of a tick, just like a binary would be, right? If I were to go over here to the Nadex platform, and let's say that I was trading binaries, and let's just say I want to trade the Dow, right? The Wall Street 30. So I pull up and, I'm looking at these binaries here that open 12 p.m. and expire at 2 p.m. Okay, if I was going to go in and buy this binary right here for $76, for example, okay, so say I wanted to buy one, and it says right here, max loss, okay, well, it says max loss $74.50, max profit $25.50. So at expiration, if I, yes, I have the option to exit early, but if I don't, I'm just holding this till expiration, okay? In 46 minutes and 35 seconds, 34, 33, okay, either this will expire in the money or out of the money. The statement will expire true or false, right? And I'll either profit $25.50 or I'll lose $74.50, okay? So once again, this binary strike is saying the Wall Street 30 will be greater than 21,217, right, at 2 p.m. If the market expires at 21,216, what happens? If the indicative is one tick, 1 point below this strike, okay, then the statement does not expire true. And at expiration, 1 tick below the strike, I would lose this entire max loss dollar amount here, correct? Everybody understand that with a binary? Okay, so if we're binary traders, we definitely pay attention to that very closely, right? When we're looking at this max loss amount, because at expiration, it's all or nothing, okay? And you cannot think that way when it comes to spreads. If I was to go over here to indices spreads, for example, and open up the Wall Street 30, and let's say that, even on a daily, let's just look at a big daily here. Right now, the indicative is at 21,220. Okay, so let's say that I chose this particular spread right here and I wanted to buy it. Okay, whoa, wait a minute. Hearts start beating fast, right? We see this right here, max loss 222. Okay, and that might scare us away. That might make us be like, oh, wait a minute, I can't do that. Because if we're used to trading binaries, what we're used to, our mental process is whatever this max loss amount right here is, it's all or nothing at expiration, okay? And we're like, I can't just lose $222 if I'm wrong by 1 tick, right? Okay, but if you're with us last week and understand how spreads work, spreads are not 0 or 100. They're not all or nothing at expiration, okay? It's based on, each tick is $1, right? So if I were to buy this spread right now, okay, and buy this spread for 21,224, okay, and at expiration, the market expired, the spread expired, and the market, the indicative was at 21,223. So therefore, it was one tick below where I bought it. Is it all or nothing like a spread or like a binary? If it expired one tick below where I bought it, would I lose the whole $224 like on a binary? How much would I lose? Let's just do a little test here, see if everybody's paying attention. So if I were to buy this spread at 21,224, and when it expired, the market expired one pip or one tick below that, expired at 223, how much would I lose? Exactly, $1, okay? Because it's based on $1 a tick. If I bought it at 224, every tick the market goes up and then expires at is $1 a tick. Every tick it goes down the other way and then expires is $1 a tick, okay? So do we understand the big difference there? Okay, do we understand the difference of one tick on a binary is the difference of all or nothing of this max loss amount? But on a spread, okay, on a spread, it's $1 a pip, $1 a tick. Okay, so my point is you cannot be looking at this max loss amount the same way that you look at it with a binary. Is that your max loss? Yes. Is that your max risk? Yes. Okay, but what would have to happen here? All right, this is the Wall Street 30. Let me pull over a chart of the Wall Street 30. So if I've got a max loss of $224, okay, what would have to happen on this chart right here? Well, right now we're at 21,224, okay? So the market would have to go down $224 for me to take that max loss. Well, if I'm managing my trade, what do you think I'm going to do? Let's say that I got into a spread because I think the market's going to go up, right? Let's say, I see that the market, is coming up, pulls down, comes up a little higher, pulls down, comes up, pulls down, comes up, pulls down. And let's say that I just think this is going to be another retrace and the market's going to go up. So I want to buy a spread and make $1 a tick as it goes up. But I'm wrong and it starts to go down. And let's say I'm wrong and it starts to go down 20, 25, 30 ticks against me. Well, I'm probably thinking, hey, maybe I called this wrong. It's not going up, it's going down, right? And I'll probably just exit the trade, correct? So I'm entering this trade at at one point I'm going to have a stop in my head saying, okay, if it goes against me by a certain amount, I just want to get out. So let's say that happened, okay? Let's say that's exactly what happened, that I think this is just a retrace and the market's going to go up, for example. So I buy, all right? And let's say I buy that spread. Let's just do this. Let's do a tear off ticket. Let me pull that over here. Okay, so I buy this, okay, thinking that the market's going to go up. But the market goes down, say 25, 30 ticks against me. And I just get out. Say I got out when it went against me 30 ticks. How much, because remember, I don't have to hold it to expiration. I can exit early, whether it's going for me or against me. All right, so it doesn't go up, it goes against me 30 ticks and I get out. How much money did I lose? Not including fees or whatever. How much am I down if it goes against me 30 pips, 30 ticks, 30 points, and I get out? $30, right? I'm down $30. Okay. Well, Right, Terrence, if I bought it at 220 and I got out at 190, then I'd be down 30 bucks. Yeah, exactly. Okay. So what would I have to do in order to lose, or what would have to happen in order for me to lose this full max loss of $220? Well, that means I think the market's going up, so I buy it, but I'm wrong and it starts to go against me, and I just let it go against me. 10, 20, 30, 50, 60, 80, and I just watch it. And I let the market go against me 220 points. Okay, how realistic is that I'm going to do that? That's me, that's either a huge flash, ridiculous flash crash, right? Or that's me just not managing my trade, correct? You see that? So with a Nadex spread, I could be wrong and let the market go against me 20, 30, 40 points, right? And exit and just be down 20, 30, $40, right? Now, what if I had bought a Nadex binary for $75, saying the market's going up? And when that binary expired, it was 1 pip below my strike. Then I would have lost the whole $75 based on 1 pip or 1 tick, right? Does everybody see the difference there? Okay, to where the very first thing I want to explain to you is you have to realize this amount right here, all that amount is technically, yes, it's the most I can lose, yes, but it's the amount that I have to put up, okay, out of my account in order to get in the trade. All right, so what I'm trying to relay to you here is I don't want to say, hey, don't let that amount scare you there. I'm just saying you have to understand what that amount is, okay? And it's not an all or nothing like a binary based on 1 tick at expiration. It's the amount you have to put up to get in the trade. All right, now let's make sure that everybody understands this and how this is figured. All right, let's squish our chart a little bit here, okay? And all right, now let's pull that back up. Okay, so we talked last week about the basics of spreads, and now every spread has a top and a bottom, or a floor and a ceiling. So the floor of this spread, the bottom of this spread, is 21,000. The top is 21,400. Okay, so we've got 21. See, this is a big spread. I've got to even squish this chart quite a bit to even be able to see those, right? So this spread, let's just draw it out, okay? So we've got from 21,400. Well, let's see here. So we've got from 21,400, okay, down to 21,100, I believe it was, right? Let's see. Or nope, 21,000. Let's go all the way here. So that's our spread right there, okay? This is the absolute easiest way to visualize and understand spreads. Is, I've said it before, I like to call them box spreads, because if you draw them on a chart, they look like a box. Because where's the bottom of the spread? Where's the floor? It's at 21,000. Where's the top of the spread? 21,400, right? Okay, Terrence says, hey, I haven't done much with spreads, but I'm learning. Terrence, this is the absolute easiest way, in my opinion, to teach and to learn spreads is to literally draw them on the chart like that, right? Because what do we know? If I'm going long, meaning if I'm buying, so I think the market's going up, so I want to buy a spread. And let's say that I buy the spread right here, okay? And I'm wrong, and it goes down. Let's say it goes down hundreds and hundreds and hundreds and hundreds of points. where is my risk capped? I think the market's going up, but if I'm wrong and it goes down, can I lose any more money past the bottom of the spread, past the floor of the spread? No, my risk is capped there. Let's say the market flew down all the way here to 21,000, and then it kept flying down hundreds of points more. I don't lose any more past this amount right here, do I? Past this level, do I? So where can I buy this, or where's the market at right now? 21,208, right? Where can I buy it at right now? 21,211. So if I want to buy this spread right now, what's my max loss? How much money do I have to put up out of my account? How much money is put on hold in my account to enter this trade? Well, it's right there, 211. Well, how is that number figured? Well, if I could have bought it at the time for 21,211, where is the max amount that I can lose? The floor, which is what? 21,000. So what is 21,211 down to 21,000? It's $211. Does everybody see that? So all I have to put up out of my account to enter this trade is the maximum amount that I can lose, because my risk is capped. I can't lose any more than that because I don't lose past the bottom of the floor. Does that make sense to everyone? So that's where that number comes from. Everybody see that? Some people are like, oh, I never got that before. That makes perfect sense, right? So that's the amount of money that I have to put up, okay? So Terrence says, so you minus 21,211 and the floor equal the money you put up. Terrence, exactly. Yes, exactly 100%, okay? Because I can't lose any more than that, can I? So that's the amount that I have to put up to get in the trade is my max loss, okay? Let's look at a different example, okay? Again, for some, this may be very elementary, or you might be, no, I got it. We don't need to cover it, but you really need to understand this part because it really does make a big difference here once you understand that. Let's look at a different spread. Let's even look at a smaller time frame spread. All right, some of these that just opened up at 1 o'clock and they're going to expire at 3 p.m. These are smaller spreads, all right? So we're at 21,193. So let's open this spread right here. And no, let's do a tear off ticket the same way, because this might, might feel like we're kind of repeating ourselves here, but we really need to get this. So where is the floor and ceiling of this spread? So the bottom of the spread is 21,175. The top is 21,275. So this particular spread is a 100 tick or 100 point spread. So let's draw it out, okay? 21,175 is the, come on, bottom of the spread, right? So 21,175 up to 21,275, right? So this is a shorter term spread. It's not as wide of a spread. Okay, this is only 100 points. The one we were looking at the end of the day earlier was 400 points. So right now I can buy it for 21,200. Okay, well, how much do I have to put up? $25. Well, why is that? Where is the floor? Where's the bottom of this spread at right here? 21,175. So I can buy it right now for 21,200. So what's the difference of 200 to 175? Difference is only 25 bucks. Because if I'm entering right here and I want to go, you know, I want to buy, I think the market's going up. If I'm wrong and the market goes down, where's my max loss at? I don't lose money. If I'm wrong, I don't lose money below this floor, this bottom of the spread. So the only amount of money I have to put up out of my account to get in this trade is the difference of where I get in compared to the floor, which is $25. Does everybody see that? Does that make sense now? How that amount is determined. Okay. So let's say that I bought in this spread and the market goes up 20 ticks, and then it expires. Okay. So I got in here at 21,200. Let's say it goes up to 2120 or 21,220, and then it expires. So to get in this trade, I had to put $25 out of my account on hold. Okay, it goes up 20 ticks and it expires. Well, at expiration, I'm going to get the $25 back, right, that I had to put up for the trade. And then I'm going to get the $20 of profit that I made, right? Because I got in at 200, it went up and expired at 220. So I get the money back that I put on hold, plus I'm going to get the $20 of profit that I made. Now, yes, minus fee. Okay. So does that make sense to everyone? What if I got in and bought at 21,200? The market goes down 10 ticks and then expires. It expires at 21,190. So it went down 10 ticks and then expired. Well, I had to put $25 on hold in my account to get in the trade, right? It went down 10 ticks, and each tick is $1. So I actually am down $10 on this trade. So therefore, once the trade expires, I'm not going to get the whole 25 put back in my account, right? I'm going to get the 25 minus 10, so I'm going to get 15 back. Make sense? Or if I bought it right here and the market goes down 25 ticks, then I'm going to get 0 back. If I bought it right here and the market went down 225, I'm still only going to get 0 back because I don't lose any below there. Okay? So, does that make sense? Okay, Terrence says, I thought the money we put up, we don't get back, win or lose. Nope, that's not correct, Terrence. All you're doing is just putting up the maximum amount there, okay, that you could possibly lose. And then when the trade expires or when you get out of it, what you're going to get is the difference of, you know, how much you were right or how much you were wrong. It's not like a binary, okay? It's not like a binary where it's all or nothing. Does this help clear it up a little bit for you, Terrence? Does this make a little more sense now of how it works? And you can see why and how it works that way? Because all that money you're putting up is, all that is for is just, you're just putting up your max loss amount, and then whatever the outcome is, you're either getting all of that money back that you put up plus your profit, or you're getting that money back minus your loss. Okay, does that make sense? It's just, think about it like a deposit. All right, it's just a deposit. It's just money on hold to get into that trade. And then it's based on the amount you get back is based on where you were. Okay. So Terrence says, nice. I took my demo account from 25K to 48K in 3 days. Well, you're doing something right then. All right. So I guess what my point is to you here, guys, is let's say that you bought this spread right here. Okay. How much am I risking total? What's the total amount that I could possibly lose on this particular trade right here? $25, right? Whether the market moves against me 25 ticks or against me 225 ticks. The max that I could lose is $25, right? Okay, so some of you are saying, man, I really like that spread, right? Only 25 bucks that I could possibly lose. I like that spread. And I like that spread a lot better than the other one you showed me a minute ago, John, right? Well, let's think about that. What's really the difference? I could lose $25 on this spread, all right? But if we went with the other spread, okay, that we were looking at a few minutes ago, oh, I could lose $197. Oh, I like the other spread better, right? Okay, well, we understand why these numbers are different, right? Because this is a much bigger spread. There's a lot more room from where we're getting in down to the bottom. So we understand why we have to put up extra money, okay? So on the other spread, the most we could lose was $25. On this spread, I have to put up $197. But if I got into that spread, that bigger spread, and the market went against me 25, 30 points, don't you think I'm going to probably get out anyway because I think I went the wrong way, right? So how much would I lose if I got this big spread, okay? If I got this big spread, had to put up a lot more money, the market goes against me 25 points and I get out. How much did I lose? Well, how much did I lose though? I got in the spread. The market goes down against me 25 points. How much is it per point with a spread? It's $1 a point. So it went against me 25 points and I get out. So I only lost $25 on this spread as well, right? So whether I choose this bigger spread and have to put up 197, or if I choose the other spread and only have to put up 25, if the market goes against me 25 and I get out, I'm still only losing the same amount, right? Do you understand how, yes, you have to have a little more in your account, you know, to get into one of these wider spreads. But just because this number is bigger right here, if you're managing your trade and you have an exit point, it doesn't really make a difference, does it? You're still only losing $25 if that's your exit point. Does that make sense? What I'm trying to say is, what you have to look at is your managed risk, okay? Your expected realistic risk. All right, whether you're putting up $25, $100, or $300 to get into that trade, it's about where you're going to exit if it goes against you. Does that make sense? That just because this number is larger doesn't necessarily mean that you're going to lose all that. It's about where do you get out. Okay, you understand now? So some of you are saying, okay, well, I get that. So it's not like a binary, all or nothing. All right? It's not like that. It's about where I get out, and it's $1 a pip. So, but some of you are saying, okay, well, then why would I choose one spread over the other? Right? Okay, well, there's a couple of different things to look at here. First of all, before we move on, any questions on what I just covered there? Does everybody understand how max loss does not mean all or nothing, like a binary? Max loss just means where am I getting in compared to the floor or ceiling? And you also understand that if you manage that trade, does it really matter whether you got in with a 50 max loss or a 197 max loss? if you're planning to get out of it, if it goes against you 25, 30 ticks, doesn't really matter. You're still only going to be managed risk of $25 or $30 either way, right? So my point is, don't let that number scare you into choosing the wrong spread. Okay, never choose a spread just based on this number. All right, you understand that? So let's look at the flip side of it. Where is this? Let's go back to the chart real quick, okay? Let's see here. So let's go. Joe, I probably won't be able to cover that today. We might get into that here in a couple weeks with one of our little bit more advanced spread webinars. I'm kind of building up to that, but yeah, give me a week or two to kind of get there. I don't want to overwhelm just yet. All right, so where is this here? Let's pull this, give me just a second here. So let's do a quick tear off ticket. Okay, so this spread right here, where are we again? 21,000 to 21,400, right? So we're at 21,400, okay, and 21,000. So this is the spread here that if I got into it, I'd have to put up $197, right? Okay. The other spread that I only had to put up $25 would have been from, that was what, 175. Okay, right, up to 21,275. So just 21,275. Okay, so this one I only had to put up $25, right? This one I had to put up $197. So just by looking at those two boxes, who can tell me what might be one reason that I might have chosen this bigger spread even though I had to put up more money to get in it? What might be a just kind of in-your-face reason right there? Exactly. More potential profit, because I think the market's going up, right? Let's say that I'm seeing it come up and pull down and come up, make a higher high and pull down, make another higher high, pull down, and I'm thinking it's going to go up. Well, if it goes up quite a bit, I make money to where? To the top of the floor, to the top of the spread, to the ceiling. Same here. In this spread, I'd make money to the top. So I've got quite a bit more profit potential in this bigger spread, don't I? Everybody see that? So that's the first question is, well, okay, I understand, that it's not just about the amount of money I put up, it's where do I manage my risk? But why would I choose one of those bigger spreads where I have to put up a little more? Well, because it gives me a higher ceiling. It gives me more room to potentially profit. Okay? Because I know some people say, oh, so I should always just find a spread where I can buy close to the bottom because it's low risk. Or I can sell close to the top. That's what I should always do, right, John? That way I don't have to put up a whole lot? Well, not necessarily so, for a couple of different reasons. That's the first reason, and everybody can see that, right? Yeah, well, Terrence, the max profit is wherever like if I'm buying to go up, the max profit is wherever I buy up to the top of the spread. If the market keeps going past the top of the spread, I don't make any more money above the top of the spread. I can make money from where I buy to the top of the spread. So obviously on this bigger spread, I've got a lot more profit potential than I do on this smaller spread, right? Okay, so that's the number one reason. So taking those things into account, this last final piece here, this is the most important piece, okay? These other things I covered are very, very important for you to understand. That's the biggest, okay, well, the first biggest misconception and mistake with spreads is exactly what I just showed you, not understanding that risk aspect, okay? And just because there's a dollar amount there, well, I'm gonna just automatically choose, okay, a different spread, because that is where a lot of people, okay, this is the part you gotta pay really close attention to. If you get this last, if you get what I've already said, but if you truly get this last part, it will completely revolutionize your spread trading. Because I've talked to people who say, hey, I tried out those spread things you showed me and they're just not working for me. They don't work. I bought in a spread, the market went up, but I didn't make a dollar. I don't get this, John. Okay, so get what I've already showed you, but this right here pay really close attention to, okay? Because this is huge. Let's switch over for a minute. I'm going to go back to binaries, because I know a lot of you are binary traders. Okay, again, binaries and spreads do not work the same, but I want to get this point across to you. Okay, this is very, very important to understand. If I buy this binary right here, okay, if I buy it and the market goes up and it expires profitable, in the money, how much do I make? On this binary, who can tell me? If I were to buy this binary, it expires profitable, in the money, how much do I make? $64.50, right? Okay. So, all right, I buy a binary, the market goes up, I make $64.50, right? Okay. If I buy this binary right here and the market goes up, expires in the money, I also make $64.50, right? Or wrong? If I were to buy this one. Well, why is that wrong? I bought a binary. It went up. I should make the same amount of money because I was right. Right or wrong, I should make the same amount of money. If I buy this one right here and it goes up and it wins, why am I not making 64? Why am I making different amounts of profit? It's a binary, it went up, I was right. I should make the same amount of money on any binary, right? Wrong. You binary traders understand that. Thank you, Reby. The price is different, right? Because it's what strike price am I buying and what price am I paying for it, right? That's going to determine what I make, correct? Okay. What do we know about these binaries down here that are very low priced? Well, we know that we're not having to put up a whole lot of money for them, right? We know that. I'm only having to put up $11 on this particular binary trade, right? So I like that. I like that low cost. But what am I buying? I'm saying that the market has to be above 21,231. Where's the market at right now? It's at 201. So it's got to move up quite a bit just to get to that strike price, right? We understand that, right? I'm paying so little for it, okay? I have such very little risk, but the market's got to move quite a bit, correct? So if you're a binary trader, should you or do you automatically just go in and buy the cheapest binary you can and then expect it to be profitable? Do we do that as a binary trader? No. Okay. So for you binary people, let's use another scenario. I buy this binary, and what do we think in our head? Buy, market goes up, I make money, right? Buy, market goes up, I make money. So if I put up this very little dollar amount here, I buy. Because my strategy or system, my charts and my indicators said the market's going up. And guess what? I was right. My strategy was right. My systems and indicator were right. The market goes up. And you know what? The market went up like 25 points in my favor. I was so right. The market, or let's say the market goes up like 20 pips. Well, the market's at 207. It goes up 20 pips. And it gets all the way up to 227. I was so right. My indicator said go up. The chart said go up. I bought. The market went up 25 ticks. And then it expires. Did I make money or lose money? I still lost, right? Because it only went up to 228. The strike I had was 231. So I can put up just a little amount of money. I can be right in my direction, and the market can go up, and not just a few points. It can go up 25. But I still would have lost money, right? Because it didn't get to my strike at expiration. Does everybody understand that? Does everybody get my concept here of I thought it was going up, I was right, and it went up a good amount, but I still did not make money. Why? Because of that small amount that I had to put up, the strike was so far away. Everybody get that concept in the binary world, right? What if I had gotten this binary strike right here? And I put up a little more, $54. And I'm saying it'll be above 207. Right now it's only at 205, 2 points away. And I'm right, and the market goes up. Well, then I would have made almost 40-something dollars, right? All of these scenarios I was right, and the market went up 25 points. One of the binaries I didn't make any money on. This one I'd have made $45 on. I had to put up a little bit more, but I was getting in right at the middle, right about where the market was. Does that make sense? Or if I want to pay a little bit of premium and get a little higher priced binary with a little bit of insurance, okay, where is this one at? 21,205. It's already above the strike price. Okay, does that make sense? So I can be right and the market can go up, but it's all about where I buy or sell at, correct? Okay, does that make sense? So what you have to pay attention to, it's the same similar situation in spreads, where you can't just go in and say, okay, here's the spreads I want to buy. So let me pull this spread up. And if I want to buy this spread, oh, look, I only got to put up 24 bucks. I like that. What about this spread? Okay, I want to buy this spread. Oh, I got to put up $209. Okay. I don't like that one. I want to go with this one that was only $24, right? How many of you have ever tried spreads and that's how you chose your spread? Simply based on, okay, this one, I got to put up 22. I like that. This one, I got to put up 206. Oh, I don't like that. Let's go with the $22 one, right? Show of hands, you've all done it. I did it, right? That's how we chose our spread. And we buy the cheaper spread. Then we see the market go up. Okay, quick, show of hands. You've all done that, right? You've all chosen a spread based simply on that dollar amount. Then the market goes up 25 points because you were right, it was going up. But then at expiration, you're like, I didn't make $25. I thought that John guy on the webinar told me it's $1 a pip. The market went up 25 pips, but I didn't make $25. These spreads don't work. Okay, those two spreads, $24 to get in this one, $200 to get in this one. Oh, but where did I buy? One of them, I was able to buy in at 21,204. The other one, I got in at 21,221. And where's the market right now? 21,202. So if I bought in to this top spread and I bought in at 221. Right now the market's only at 201. So if the market went up 25 ticks, what would that be? That means it would expire at 226, correct? Everybody understand that? If it's a 201 now, it went up 25, that means it would be at 226 at expiration, correct? So what do I get? I get $1 a tick from where the market expired to where I bought in, which should only be 4 or 5 ticks, $4 or $5. Did everybody get that? So I'm like, wait a minute. When I got in, at the time I got in, the market was at 203. And then when it expired, the market was at 226. So I should have made $23. But that is right about where I bought it at. Does everybody see that? That's what's called premium. Yes, on some of these lower cost spreads that are close to the floor or ceiling, you don't have to put up a whole lot, but there's a little bit of premium built in there for that insurance. What does the word premium make you think about? What's something you pay a premium on every month? Your insurance, right? You're not having to pay a whole lot for that spread, all right? You don't have to risk a whole lot, but there's a little bit of premium built into it, right? The market's got to move a little more, just like on that lower cost binary. But what about this spread here? I had to put up a little more for it, but I was getting in. Where's the market at right now? 205. I can get in at 206. I've only got $1 difference there. So if I get into this spread as the market's moving up tick by tick, then my profit and my P&L is kind of going up about tick per tick. Does that make sense? Does everybody see that? Look at the different prices here. Each spread has different floors and ceilings, but there's also different prices of where you can buy that spread for. Just like on a binary, the market might be at a certain level, but you're paying different prices based on that contract. Okay? Does that make sense? Do some of you see now where you've gone wrong with spreads? Because you said, I think the market's going up. I want to make $1 a tick. And so I'm just going to go in and buy the spread. and I'm going to get into, oh no, 210 bucks. Ooh, I don't want to do that. Let's check this one out. And I'm just going to grab that. Oh, look, 24 bucks. I want that one. And then you're sending me a message going, John, you told me these were $1 a tick. I didn't make $1 a tick. Yeah, you did, because you bought it where? At 21,222. When you bought it, the market was only at 207. So when it's at 206, 207, goes up 25 ticks, and it gets to 31, you bought it 21. So you only made $10. But you made it from where you bought in to where it expired. So once again, you say, why would I choose a spread where I have to put up more money than another? Well, one reason might be because it's a higher floor, right? And you've got more room to profit. The other is, hey, I might be able to get into one of these other spreads. I might have to put up a little more, but I'm getting in right where the market is. So it really is going to be more tick for tick for me. Does that make sense? Now, let's say that, you know, I'm expecting a big, huge move in the market. Like I'm expecting the market to go up. You know, I'm not expecting just a 20, 25 tick move. I'm expecting the market to go up a lot, like 60, 70 points. Well, then maybe I might want to look at this spread. Okay, the market's at 200, I'm buying in at 220. So I'm giving up about 20 ticks there. But I'm expecting a 40, 50, 60 move, and I only got to put up 20 bucks. And maybe I want to do 4 of them. Right? So I'm not telling you to never use those lower price spreads. I'm telling you it's all about the expected move of the market. Okay? So keep those things in mind, guys. Those are the top kind of mistakes there. And we're going to build some more on this as we go on. We're going to talk a little bit more about choosing the right spreads and how different spreads fit into, you know, different strategies and systems. Is it a range-bound day? Are you expecting a small move or a big move? Okay? But those are some of the basic things there that you want to pay attention to. Never choose a spread only based off the risk and reward amount. And always be mindful of how much room do I have to profit or loss? Where's the floor? Where's the ceiling? And the biggest key right there is what price am I buying into? Okay? So, guys, I hope that helped you out there. We've gone a little over time here, so I'm going to have to let us wrap up here. So I hope that helped you out there to understand some of those common and basic mistakes there of spreads and, you know, what mistakes new spreaders make there. I appreciate you guys joining us here. Like I said, join us here on the next upcoming webinars as we'll build a little more on this subject here. Okay, so I'm going to go ahead and stop our recording now. I appreciate everybody being with us, and we look forward to seeing you next time. Okay, guys, I've got our